been a while since I've done something from the ground up like this, but there's no required knowledge for this class. There's no required knowledge or anything like that. But however, all the resources that we're using as well are going to be absolutely free. I would advise that we get everyone on TradingView. I'm going to put a link in there in the chat. It's basically it's a free service, but if you do decide to end up going with one of their paid plans, you get $30 off if you make the account using this link. So I mean, you may as well. And obviously, it doesn't cost anything. It doesn't require any cards or anything like that. It's absolutely free, which is wonderful. And let's see.
I like the music.
Nice. Yeah, it's pretty chill.
We're going to be starting soon, guys. Just waiting for the screen share to start up.
Alright, let's get the stream up and running here now.
In the meantime, don't forget to smash the like button and share it with your friends, because there's going to be a lot of valuable information to come today.
Hey, what's up?
Hey, what's going on, man?
Just chatting with Monty there. I just realized he was 10:01, so we jumped over.
Yeah, we panicked there for a second. No worries, man. I'm just giving it a minute here. I'm just about to put the stream up. I have it recording as well, so I will be able to post a recording of it.
What's up?
Oh, snap, JP.
No, I got this guy.
I love it. All right.
Hey, guys.
Hey. So what we have here is Legatus Trading Beginner Class 1. We are going to go over a lot of concepts that may be very familiar with a lot of you guys, but we do have quite a few new people, and we do want to make sure that everyone is on board with what's going to happen in the coming days, because essentially by the end of this course, or well, not course, but class, what we're going to know is we're going to go over how to use the software and platforms that we use in an easy to learn way that is effectively useful for you no matter what you're trading or analyzing. And basically we're going to clear up exactly what we do on a daily basis and how we can understand and essentially not follow along but learn with us as we trade during the day. And I want to make it clear to everyone how we stream our charts during the day, and there's a lot of analysis that goes on. And basically we're going to show you guys how to set that up so that you have the ability to analyze like we do, and also understand exactly how what the analysis means, and exactly how we can essentially get a start with moving forward into learning technical analysis. So we're going to get you all your tools and everything ready, so that when we are trading tomorrow, you'll have a lot better idea of how it's works. So we're gonna teach you that, and then we're going to look into how we effectively use that information and have used that information on a previous day. So I've literally taken our trading day from last week, one of the trading days that wasn't extraordinarily slow because the holiday, and it's why we focus on it, TradingView setup, how to find a setup, know when to trade, when not to trade, what different patterns and movements can indicate, and creating a plan, like what broker, what software. Every individual is different depending on how much capital that they start with, what their intentions are, and of course everyone has like a different circumstance, I guess you could say, that may affect which broker or software that they use, but generally it's pretty much the same, and we do have recommendations, which we will go over today. And of course, how to manage your trade, finding your entries, your stops, how much size that you take with a trade. All of these things might be iffy at the current moment, but there is a system that essentially eliminates the worry of should I do this, should I not do this, and that's what we're going to go over today. And using a system that covers all the aspects of analysis. So like whether there's multiple different types of analysis that you can get out of a chart, and we'll go over all of those and exactly how to effectively combine them so that we can get the best results possible out of it, and how to learn a trading system and honing the discipline to execute that trading system with precision. You wouldn't think, but discipline is actually very huge. Knowing what to do and then having the discipline to do it is a very it's a battle for a lot of traders. But once we get down that, we're on the right track. So what are futures? Futures are financial contracts obligating the buyer to purchase an asset or the seller to sell an asset and have a predetermined future date and price. So basically, I'm not going to go too far into what futures are, because at the end of the day, just like stocks or options or whatever you are familiar trading, whether it be forex or even crypto, we buy a security and we sell it as we would a stock. Simply, we don't need to really understand the nitty-gritty ins and outs of what makes the futures contract available for us to trade, but rather how can we take advantage of the fact that there's something out there that allows us to trade with extreme precision, with tight spreads, and we'll go into all that soon, but basically gives us an extraordinary advantage over many other securities, and that's why we trade them. So it allows the investor to speculate on the direction of a security, commodity, or financial instrument, basically. So we trade futures on indexes primarily. The most important, in my opinion, futures contract that we trade and that you'll hear about is MNQ and NQ that follow the NASDAQ index. Now, we like the NASDAQ index because it's 100 tech stocks, the top tech stocks in America, and it gives us one thing that's most important, and it's volatility. And volatility means movement, and frequent movement for that matter. So frequent movement means that there's going to be frequent opportunities and frequent patterns for us to analyze and take advantage of. So, as well, futures can be used to hedge the price movement of the underlying asset to help prevent losses from unfavorable price change. You might hear futures or options to be used as instruments that can be used to hedge. We're not going to go into hedging today, which is a little bit advanced, but it's totally on the curriculum. Futures trading is a great tool to get exposure to short-term price action of major indexes, commodities, and even currencies. So, whether you're playing it long-term or short-term futures trading, you can do both, essentially. Another good thing about futures trading is they're only closed for 1 hour every single day. So from 5 p.m. to 6 p.m. Eastern and Saturday. So the availability to be able to trade is there. Now, some days you'll notice that after-hours trading sessions are a little bit slower. Some days they're not, though, and they're perfectly fine, and they trade just as a normal day would. But another major thing about futures, why we do like teaching and introducing them, is because we have the ability to day trade with no PDT rule. Whoops. I can also put this on too, so just in case. So there's no pattern day trade rule applied to futures trading. We can essentially trade with a low account size. Like, you don't have to put $25,000 into your account. You can start with one. I recommend at least 3, to be honest. It would make leave yourself a little bit more breathing room, because especially if you are, first beginning, it does make sense to start with 3. Now, it does depend on what broker you pick, because the futures contracts are priced differently depending on what broker you choose. Now, we have our recommendation, which is relatively cheap, and it's actually extraordinary how cheap you can get into a futures contract for as little as $50 to be able to get exposure to something that will move hundreds of dollars. So, that's quite interesting. Now, there are futures contracts that range anywhere from the low hundreds to contracts that cost an initial margin of over 20K. Now, some brokers will charge different prices for their contracts. So we're going to focus on the ones that essentially give you the best deal and bang for your buck, because you don't want to be putting in $20,000, $16,000 for something that on another broker this guy might only be paying $500 for. So that extra money is essentially it's out there for no real reason. There's also low commission costs for trading futures. It does depend on your broker again, but we're down to under $1 per trade generally across the board, and so it's not something that's going to cost a lot of money to essentially make your trade. And it's generally negligible. So with contract size, this is a chart that basically explains that each index contract. So we can trade, many of you will have heard of the SPY, the NASDAQ, the Russell, and of course the Dow Jones Industrial Average. Now, these are all of the indexes that we mainly focus on, with the NASDAQ being the most predominantly focused on. And I'm not going to spend too much time on this, but we do have 2 different size contracts. Now, when you're beginning, I would focus on the micro size, because it is 10 times smaller than the large size contract. So we can see that each time that the price fluctuates, it moves in points or ticks. Now, on the NASDAQ, there's 4 ticks to a point. So they're basically just like the micro movements within a tick, or within a point, sorry. So you have 4 ticks in a point, and essentially we're looking at this chart here, and you can see the difference. So on the mini MNQ, which is the one that everyone will essentially start with trading, you can see that that's only 50 cents a tick as opposed to $5. So the magnitude of the contract is different. So you would start out by trading the smaller contracts. These are only worth $50. Some contracts charge $100, but at the end of the day, go back 3 years and look at any broker. They were charging upwards of $1,000 for one of these contracts. So the prices have significantly dropped, and it is significantly cheaper to get involved with trading futures. So that's why it's that much easier. You don't need the 25K. You can trade things for cheaper, and meaning you can get into a trade that'll move hundreds of dollars for just something as simple as $50. Now, it does depend on how the market's moving, of course, but I just wanted to give you guys an idea of how the contract sizes work. So basically, we'll be focusing on the micros there, and we'll save these ones for later. So basically, the first step for new traders is finding out how to use the tools that we use to analyze and execute trades. A broker and platform setup that allows you to execute trades quickly and precisely. Charting tools that possess all of the tools required for analyzing harmonic and Elliott wave patterns, which we will get into, but basically patterns and trend analysis and customizable indicators that you can essentially work with. So what we recommend is TradingView for that. So essentially, I haven't seen another charting platform that's essentially more advanced and user-friendly than TradingView. And we're going to go over exactly how to set that up in a way that's easy to understand what we'll be doing tomorrow and the days to come as well. So, understanding the trading concepts, learning the patterns, and practicing the execution of basic strategies strategies, and focusing on building good habits. Learning how to manage a position so that you can gain the maximum profit potential while learning how to reduce as much risk as possible as you're managing your trade. And that's basically what we're going over here, and how we can essentially take one trader that has no knowledge of exactly how to strategize about what they should do, or if one feels lost when they come in every morning to like, what is the market going to do to me every day, like what's going to happen, like that, those mindsets, like we can eliminate those with strategy and with discipline and perseverance as well. And we definitely want to make sure that we have like persistence. Essentially, we want to make sure that we stick with our learning curve, and make sure that we are consistently learning everything that we have for you guys. And I do have it pretty much set out as a step-by-step kind of way that we can learn exactly what's required to be able to get to the same stages as many of the traders that we can see are doing that. And so what makes us take a trade? So technical analysis is the backbone of all of our methods and strategies. Using candlestick and chart patterns, we are able to find and execute trades with precision on a daily basis, where every single day kind of blends into the last, because we have so similar results on a daily basis that last week's trading may seem like a blur to what is to come, because essentially we wake up every morning, we execute the same strategy, we follow, well, not like the same strategy, there's different like movements the market will give us on a daily basis, and we will have systems in place to essentially work alongside any strategy that we're trying to implement. So like we make sure that we cover all the bases before we move on to trading the pattern. Make sure that there's nothing wrong with it, essentially. Making sure that we've covered every single different type of analysis that we can do, that we will go into as well, because there's only so many different indications that we can get out of a chart, and does it not make sense to use all of them, on every trade, to make sure that we cover all of those different indications, and make sure that they're indicating something that's favorable for us on every single trade. And that might seem like a lot, but honestly, it can all be broken down into being able to do all of that at a glance. And that's essentially what we're teaching here, is essentially how to take all that information, put it into a system that we can train you to execute at basically subconsciously, so that you won't take a trade before checking all of the different steps that are required, to making sure that you have that potential on your side, to make sure that trade is profitable. And when we're scanning for trade opportunities, we're looking for particular patterns that provide exact entry and exit targets that we can then analyze using our charting software to determine the likelihood of it fulfilling its intended price target. So that's essentially like the goal of what we are looking for here. So TradingView. I believe that I've posted a link in the chat for anybody that doesn't. Oh no, I didn't put that one in there. So what I'll do is I'll post a link here, and I'm going to start this from scratch, because I know a lot of you guys haven't set it up yet, and I want to make sure that everyone understands TradingView, because that's the first step in being able to understand the rest of what we teach. Being able to use the tools that we have, so that you can then understand the reasoning behind why we make a trade, and why we want to analyze particular patterns. So that's the TradingView link. For anyone that doesn't have it and that wants to follow along. So essentially, what I'm going to do here is I'm going to start fresh on TradingView. And
just so you know, I didn't see a link on there at all.
Oh yeah, it should be in Legatus exclusive now. TradingView. I just put it in there. Yeah, my bad. Before I thought I sent it, but it's in there now. And essentially, when you open TradingView, it may ask you to, make an account, which obviously is just your email and whatever login info you decide to choose, and then you'll see something that does look very similar to this. And essentially, all we're trying to do is launch the chart so that we have a setup that looks like this. And then we'll go into exactly what we would do in order to make it the most effective charting space and an area to be able to effectively find patterns and get as much clarity as possible out of it. Did you manage to find the link there, Doc?
Yeah, I'm in TradingView now.
Perfect. Yeah, so if we are on this, if we get to the log chart there, one of the first things that I personally like to do is I'll right click on the chart and actually change it to a dark theme, just a little easier on the eyes. Once we're in there, basically, like you might have this on the side here. You can just click the top right to make sure that we have a full chart there. You can also full screen it if you wish as well. We should be able to still see that. And essentially, this is just a browser that I don't usually use. They do have an actual program that you can download off the website, which I do use and stream throughout the day. But this is honestly exactly the same once you full screen it, and we are exactly in the right spot here. So basically, we might see that we'll have some tools on the left and some tools across the top that may seem confusing at the beginning. But basically, what we're interested in doing is being able to analyze from a top-down approach, understanding that each trend line that we draw in right now is going to show up on every other time frame. So I actually wanted to go over basically how we view this chart. Like, I know some of you are brand new and you might not understand exactly how each candlestick moves. Now, one thing that I want to explain is just the basic movement of each candle. So on a green candle, that's essentially meaning that within that time frame, it's up. Like right now, we're looking at each candle is 1 day, so you can actually change your time frame accordingly. Like if you wanted to look at each candle was 1 minute, this is the most commonly used time frame in our chat right now. And we also like to moderately switch between time frames throughout the day to give us a better outlook on exactly what's going to happen. But in order to understand this chart, we first have to understand how the candlesticks move. And when we can see that a candlestick is green, it means that candlestick throughout that time is positive. So where that the bottom of that thicker part of the candle starts, that's where that minute started. And essentially where that green part ends is where that minute ended. So like, for instance, this is a chart of Apple, and essentially it started at 139.44 and it ended at 139.52, and that was the price movement for that minute. But we can see that there's also small, there's like a line on it. We call that the wick. That wick is where the price has been in that minute. So within that 1 minute, we can see that it actually dropped below where it started for a slight moment before ending all the way up here. Now it did have, like sometimes you can see that, like on a candle where there is a wick on both sides, like this one, you can see that it started at the low of the inner body, which is the thicker part of the candle, and ended at the top. But at some point within that minute, it went to where that line was, where the wick was. So that basically just tells us the price went up there for some point within that minute, but ended up closing where the thicker part was. Now the same is in effect for the red candles. The red candles begin at the high here, and then they actually, I have something that might clear this up real quick. I'll just show you guys briefly. Yeah, right here actually. So a bullish candlestick, it opens at the thicker part, closes at the thicker part, but the high of that minute was where the high of the wick was, and the low of that minute was at the low of that wick. So then the exact opposite is the case for the bearish candlestick. And essentially, the most important thing that we can do when charting is identifying the trend. And one of the most important tools that we can use for that is a trend line. Now, what I'm going to show you here first, before we get into trend lines, is actually what we typically analyze. Now, if we go up to the top left here where it says Apple, it might say something else if you've just started an account, but it may very well say Apple there. Generally, like what we like to do is look at NAS 100. That's the NASDAQ 100 index. Now, many of you will notice that the prices are slightly different on the indexes to what they are on the futures contracts. So if you're trading MNQ, you might notice that the prices are a little bit off, but all of the candlesticks are exactly the same. And it's a benefit to using the actual index, because the index will go back, let's say, for instance, if we look at the 5 minute here, it'll go back a lot longer and give you more data than the MNQ will, because of the reason that futures contracts are set to monthly intervals. So your data, depending on your broker, may not go back more than a month, and that could mean not finding a particular daily trend line or finding a particular daily pattern, like where it goes back farther than a month. It might not be available, but on the index it shows us, like, we can go all the way back prior 2008 and look at analysis there if need be. And essentially, one of the most important things that I like to do is called the top-down approach, that essentially gives us awareness of all of the trends on the long-term time frame, and they give us an idea of where we're located in regards to the long-term trend. So if we look up here on the left, we can see that there's like a little line. That's our trend line tool, and essentially this is honestly, yes, it's one of the most basic tools that we use, and essentially all you would do is click on it, and then you can click on the chart in two locations and plot a line. Now that line, it might seem very, very basic and so on, but honestly, there's not a day that goes by where we do not use this. Not even an hour that goes by. I'm questioning minute, but literally some days there is not even a minute that doesn't go by where the market isn't considering at least some trend line. Now, the reason why trend lines are so important is because when a trend line breaks, it creates a new trend. So the first concept that we learn when we're considering trend lines is support and resistance. Now, that can be as easy as taking a line and plotting it across the lows and the highs of our current range. So essentially what that's done is it's given us our resistance line, which is always above current price, and our support line, which is always below current price. So because it's supporting the price, and this one's resisting, essentially. And one other cool thing that I think should be a default setting, I don't even know why they cut off the lines, but I do like to extend the line to the right, because in the future, you'll see that just like it responded to these two, it may very well continue to respond to that trend line again. Now, what's interesting is you can actually plot these other, and this is just purely on TradingView, you can plot these other check boxes here. I wouldn't click the always show stats at the bottom, but what that does is actually give us information on that trend line. So you can see the angle of the trend line, which is something that's very overlooked in a lot of different trader strategies. You can also measure how far it is. Like you can see that from my first click to my second click, it is 357 bars or 504 days. And that sometimes can come in really useful when you're trying to measure exactly how much a move is. Like we can see, okay, that was 13 bars. It moved 1,900 points on that drop, which is a lot of points. And essentially, sometimes you might use that for that tool. But essentially, what we want to take home from support and resistance is, or from trend lines, is that they're support and resistance lines at heart. And essentially, what this means is when we plot in a support or resistance line, like for instance, right now we can see that the price is going up on this chart. So the most important line is going to be the line that's supporting it. And I have a system of creating the most important line as a yellow line, almost like a gold line. And many of the traders that are in here have experienced this. And we're going to go over exactly how we use this and how we have used this and how effective it has been by the end of this class. And essentially, so because the price is going up, we've connected the support lines that are supporting the current trend. Now, just like when in reverse, if the price was going down, the most important line would be the one that's the resistance line. Now, another cool thing about trend lines is we can go over and we can actually hit this magnet tool and get weak magnet, and this actually gives us a little bit more precision. Now I'll show you. So if we look here, I can click my trend line again while the magnet tool is applied, and it actually makes sure that I get that very, very top part of that trend line. And I find it extraordinarily useful because sometimes, we are human and it might not be perfect if we do it ourselves. So it's really important to use that. I use that personally. I think it's really, really helpful. And one thing that it does is it reduces the amount of time that you have to spend making sure that it's perfect, because it will be when the computer has the magnet tool like that. So essentially, the point with the trend lines there is when the price is going down, connecting the highs is incredibly important. And the reason why is because when we break the resistance of a downtrend, it changes trend. And that new trend can either be a sideways trend or a reverse direction. So if it was going down, it'll reverse into going up. And now that's extraordinarily favorable to somebody that's looking at predicting what where the market is going to go and what direction it's going to go in for how long. Now, this is just one thing that I think is one of the most important things, because no matter what pattern or indication that we're using, at the end of the day, there's going to be a resistance line or a support line that we're interested in breaking. And that's why I think it's incredibly important to learn these first, support and resistance. So here, I'll even go ahead and we can go ahead and draw those in. Another thing you can actually do, which is kind of cool with this, is you can actually draw it in on the trend line. Oops. If you wanted to, you could show text and write support on it, and it should follow your trend line. But regardless, that's kind of irrelevant. Essentially, we want to make sure that we look for whatever line is going to be supporting our current trend. And tomorrow, you'll be able to see this in action on the 1 minute, as well as later on in this class, we're going to bring up some of how this has actually been incredibly effective. Now, a few things that are interesting about support and resistance. Now, we know that when a trend breaks, it creates a new trend. Now, if there's more to it than simply just drawing in your support and resistance lines, because how do you know when it's going to break? How do you know if it will even break? And how do you know if it's going to go into a sideways trend when the trend does break? Because that's the worst thing that can essentially happen, because you need movement in order to profit. If the market is going sideways, unfortunately, there's not much you can do. Like, there are things. We have people that trade special securities that are intended on making money for when the market is going sideways, but that is extraordinarily advanced, and we aren't going to be focusing on that anytime soon. But the main thing that we're going to be looking at is exactly how to analyze the market on the short term and the long term to be able to combine those two essentially analytical those two analytical pieces of data and we'll crunch them together to determine what is the highest probability trade. Um, so I just wanted to go over exactly how to draw trend lines and exactly what the purpose is there. Now, why that is important is because every other thing that we do is regarding. Hold on a sec. It regards every other. Here, I'm just gonna pull up my trading view here because I think it's giving me a little bit of issues for not having an account. So I have an account. So that essentially, as we go on, I'll show you how to add the indicators and everything. I don't want to overwhelm you guys too much, as I know that it can. I want to be very specific about what we're talking about today. So another thing that you can do, if you are interested, in order to get your chart to look a little bit similar to mine, you can adjust the appearances. It's not 100% necessary right now, but you can increase the brightness of the candlesticks. I can post all of these in the chat so that you can see exactly like how I get a little bit more of a pop out of my candlesticks and see just that little bit of added clarity, because clarity is huge. Also, I do like to remove the grid lines as well, but that's essentially not what we're gonna talk about right now. I wanted to essentially go over what builds a trading strategy, and I want to make sure that we understand what a trading system is. Now, a lot of you guys have understood the 7-step trading system that I've went over before. I will be going over it again today with a few added changes as well to add some clarity and perhaps some effectiveness as well. So we follow a trading system while trading any pattern or executing any strategy. Having the discipline to execute a step-by-step plan alongside a system that supports your pattern strategy. So essentially, what we're going to look into now is like how to construct a trading strategy, how to implement that strategy, and where to begin this week as to what you can do when you sit down at the computer and you're like, okay, everyone's sitting here trading, making money. How do we understand what they're thinking about so that you can effectively get on board with being able to understand our analysis and make the same trades that everyone's doing, and creating a daily trading plan so you understand exactly what to do and when to do it. Because at the end of the day, when people are emotional about trading, in my opinion, it is because of lack of system and strategy. Because when you have a system or a plan, essentially what that does is it eliminates the worry and the fear of the unknown. Because if you understand exactly what is going to happen in the event that you're right or you're wrong and you're comfortable with it, what is there to worry about, right? Essentially, that is the basis of why it's so important to understand a solid strategy and understand what that will make you do in the event that certain circumstances arise. And that's essentially why we've broken it down to this. And essentially this 7-step trading strategy, we're going to dissect it a little bit, and we're going to make sure that by the end of the day, we want to have it so that when we sit down at a chart, each one of these concepts we do subconsciously, and we make sure that we check all of these things. And you know what? It's not too difficult at the end of the day. There's like one thing that I've noticed about teaching trading is if we look around, there's many different types of people. Like there's not one thing that makes them in common from who they are, like what their profession is, what they enjoy doing, anything like that. You know what they all have in common is that they can follow a strategy, they can follow a system, and they have rules, and they implement those rules on a daily basis like clockwork, and then receive the same results collectively. So that's exactly what we're trying to do here is give you that conceptual understanding of what system and strategy we use on a daily basis in order to effectively take advantage of 90% of the moves in the market. And essentially here, so planning your trade, having guidelines, have a clearly defined, a list of clearly defined goals is amazing, because what it does is it creates a path for your mind to essentially focus on instead of worry. Because when your mind isn't focusing on a strategy that makes logical sense, 9 times out of 10, the human brain will go to something illogical, and most of the time it's an emotional decision. So what we're trying to do is eliminate as much emotion and get onto what is logical, what the market respects. The market wants to be traded in a certain way, and essentially, whatever we feel or whatever we want, the market doesn't essentially care. It wants to be traded in a way that it respects, and we have to acknowledge that. And essentially, through the years, we've been able to determine exactly what that way is. So, each trade, we're inclined to implement a system along each strategy. So let's say, for instance, you have a pattern, and that pattern indicates that it has a specific entry target and a specific exit target. We will implement this system that we're going to go over no matter what pattern or type of trade we are getting into. So, taking the steps to find a good risk reward is another thing that can eliminate that emotional factor. Because if you have a clearly defined risk reward profile on every single trade, knowing that, hey, I'm willing to risk this small amount in order to gain exposure to potentially a high probability of being able to get a larger amount, making it worthwhile endeavor. And then when you do succeed at one trade, it should pay for multiple stops or bad trades. And essentially, they will happen, and it's how you manage and essentially move on to the next trade that's really important, and how we can actually manage our trades before we even get into them, to know that, hey, we're committing to this risk in order to get this reward and no more. So there's no way that the market can take complete control over any one of your trades when you've said, hey, this is exactly what I'm signing up for on every single trade, and don't sign up for something that's going to make you worry and freak out. Give yourself that at least. We're not going to do something that would be illogical, right? So we have to focus on what is always logical for you as an individual, and what the market is going to respect as well. Like, for instance, sometimes the pattern is simply too small to play, and sitting on the sidelines for that small pattern might be a good decision, and we'll definitely talk about that as well. But in creating the system, I intend for the trader to be aware of every area of the trade on execution. Having a checklist approach ensures that you're aware of the basic aspects of the trade before considering it. And having steps that increase the probability of the profitable trade is important. Knowing what to look for. Combine those steps to achieve balance and ultimately create clarity and consistency when executed properly alongside your strategies. So, a lot of you guys will have seen this as well. There is some changes that I've made as well. So step one, and I'm going to go over these on the chart as well, how to look at them. But the first thing that we're going to want to do is check the validity and the volume. So, are there people trading whatever you are trying to trade? Like, if you buy it, are you going to be able to sell it? Now, with futures, I want to say you are always going to be able to get filled, because there is an extreme amount of liquidity in the futures market. If you put an order in there at the current price, it is extremely likely that it will be filled instantly. And, other people might trade poorly, like thinly traded stocks. You might try to get in at the current price, and it may not let you because there's nobody willing to buy it. Now, that would be a big red flag. Now, just in general in trading, when you're looking at trading something new, this is a step that I honestly would never expect somebody to really overstep. But honestly, you'd be surprised. It's very people get involved with different securities. Like, you might be trading something like natural gas or something, and it might not be moving as favorably as the NASDAQ, and you might have issues trying to get in and out. So those are that's one major thing that I would expect everyone to be aware of. Now, this step is automatically automatically checked off anytime that you're trading NQ or MNQ because you know you're going to have volume. Now, you can watch how much volume there is now compared to what there was before. Like a perfect example of when we should check if there's enough volume is on a time like right now. Like if anybody's like trying to trade right now, like we can see that the market is barely moving here. And that's because, well, it's moving a little bit, but honestly, throughout the night, we can see that the holiday hours has basically sent this into, it's having difficulty moving more than 10 points, and 10 points is not a favorable range for many traders due to the fact that we can get like extraordinarily larger ranges when the market is moving. Like this is the 100-point range when the market was open, and on during times like this, during holidays, like we would say, hey, that's a huge red flag because like there's not very much profit potential on the table in this tighter range because there is a lack of volume essentially, and volume is an interesting indication. You can, if you ever want to get an indicator on your chart, you can always just hit indicators here, and by simply just putting in volume, volume with an M, basically we can just click that on, and what that'll do is that'll give us these bars, essentially telling us how many shares or contracts in this case were traded within that time frame. Now, just like we did before, we can change this so that every single candle is 1 day, or we can change it so that they're 1 minute, and those bars will correspond with whichever candlestick it's currently on. So like for instance, like this red candle right here, it had a substantially larger red candle, red volume bar, and that just indicates that there was a lot more trading in that bar than there was on any of the other bars. And we can see that as it came into this really tight range down there, the overall volume kind of just slumped, and as a result, it could barely even move. Oh my goodness, that's 2 points. So that is untradeable as far as I'm concerned. In that range right there, it's a very, very, very seldom that we will get a range that's 2 points like this. But it is 4th of July, and a 4th of July holiday at least, and essentially that's why it's doing that, because everyone is essentially on holiday. And no, we don't see that usually, but I just wanted to quickly go over that. And basically, is it realistic to trade this right now? That is a question that we should all ask. Step one, literally, and that's like one thing that like it ruins the rest of the entire process. That's why it's step one, because there's no step two without it like within a 2-point range, right? So essentially, because it's in that 2-point range, you're not even looking for step two. In that point, it would be the educated decision to say, hey, I'm going to wait for it to move as it usually does. I'm not going to, quote unquote, force a trade within this range, because it would be an emotional decision and it wouldn't be logical, because the profit potential just simply isn't there, and the patterns aren't even there. It's barely moving. So those are things that would be huge red flags. And is there pending news or earnings? Like for instance, like when we have like the Fed meetings, like you will see in the chat, we talk about them so frequently. Like you won't miss whether or not there is a Fed meeting or a news event that we're literally waiting for. And generally speaking, the anticipation of whatever meeting that is, or whether or not there's like a report coming out, like unemployment, for instance, like that's huge right now, because everyone's interested to see how many people are unemployment, because that are unemployed, sorry, because that affects how much, or it affects the economy, sorry. It's huge. And everyone likes to know whether or not it is good or bad. And when that report does get released, you'll notice that a high amount of volatility will suddenly take place. We will get, a lot more movement than usual, and that can essentially come as what we call a surprise, because nobody truly knows what the report is going to say. And now, what's interesting is instead of actually, making a trade in anticipation of what way you think it's going to go, which is based on no real analysis, in my opinion, you put yourself up for that surprise, and it might be favorable, it might not be, and we don't take trades that have any sort of might associated with them. So when the report does hit, we generally wait for it to respond in a manner that we are favorable with, because when it creates that movement, it gives us an opportunity, not before, but immediately on that movement, we can then take an opportunity out of it, 9 times out of 10. And it's that patience waiting for that clear setup is very important, rather than trying to anticipate what you think is going to happen to some report, which we have no data on. But essentially, we would wait that out and check the validity of the volume and the volume profile, which is one thing that I did a whole class on exactly just how to use the volume profile. But this is one thing that is it comes with their $5 a month plan. But what's interesting is it's on your platform already, so it's your choice to decide whether or not you want to have it on your chart here as well for $5 a month. I mean, but or get just use the one on your chart. Now some people use both. It doesn't really matter which one you have it on, as long as you can see it realistically. And as you guys get on your trading platforms, you'll see that will be an option that is generally it'll just come included with the platform. But essentially what this does is, just like how we have volume profile bars on the bottom that tell us how much volume is in each candle, this tells us how much volume is at each price level. So we can get a really good idea of how much volume was happening at any given time, because we can then see, okay, this level here, it's got the most bars, the thickest bars, they come out the most. That is the highest volume node, as we call it. The POC, the point of control, is this red line. That is the one bar that is the heaviest bar amongst them all. Now I'll just quickly explain as well the non-shaded part, like the green and red part here. That's just 60% of where all the volume was. It's as easy as that. There's not really any more complicated information in regards to the value area or POC there, but there are many different things that we use this for. But this is I don't want to go into that too much there. This is just the volume as per price levels, which it's an extraordinary indicator, and I do recommend talking about it, but I don't want to waste up too much time there on that one. So step 2 is check the volatility. And does the security or index move enough to make patterns or have clear setups regularly? Like, what patterns does it usually make, and do they play out effectively? Like, and that's one thing that we like to look for is what kind of characteristic does this security have? Like, does it like to make a particular pattern every time? And I know we haven't went into patterns or anything yet, but we definitely can. And the type, so Bollinger Bands are an indicator that basically tell us whether or not there's high or low volatility. Now, personally, we don't really use them as much anymore, because it is easy as looking at the price chart and seeing, hey, is there a small amount of movement or a high amount of movement right now? Now, one thing that I'm going to explain with volatility real quick is that when the price moves in low increments, when it is ranging in a short-term tight range like that, the volatility tightens up, and essentially that means that there's not a lot of movement. But what that means is that movement is coming. Now, we can see that out of every single time that it decides to go sideways for a prolonged period of time, it creates large movement. So we can see, it goes sideways, and then creates a large movement, and then it goes sideways, and then creates large movement, and then, I guess we're in sideways right now, but it is holiday. Then, do you expect large movement coming out of this week? So it would make sense. Yeah, like, there's many different indicators that we can use to check volatility, but basically, is it moving enough for us to be able to trade? Like, is this a one-time move, like a pump and dump based on some kind of news remains, it remains volatile, yeah, and retains that volatility, and so that you can continuously trade your patterns on it. So another thing as well is volatility. So when we talk about volatility, the word consolidation comes to mind, because if it's not volatile, 9 times out of 10 it's consolidating. And in a consolidation, we have methods and strategies to be able to trade within consolidations. But as you're beginning, I would suggest to avoid consolidation entirely. And when we are trading in a consolidation, that means that the moves are about to increase in volatility. But because, and I'll explain consolidation briefly. So when the price essentially stops moving in its volatile range, what it does is it gets into a consolidation, and like we can see, I'm just trying to find a good one there. Like here, for instance, once the price has stopped moving around sporadically, it'll move into a phase which we call a consolidation phase, and that's interesting because 9 times out of 10 we will see this consolidation phase happen in the form of a triangle. Now, many of us will be familiar with symmetrical triangles, and at the beginning, like if we look at last year and so on, like the rule was to make sure that we stay away from symmetrical triangles due to the fact that when the symmetrical triangle is done its completion, it has sporadic movements in both directions generally before it creates a new trend, which can make it rather difficult to maintain an entry. So when we see triangles, generally the first thing that we like to do is stay away from them, because you know how you get a triangle is when you're sitting there and you're analyzing your support and your resistance. And when your support and your resistance converge into a tip, it leaves you with a triangle. And generally speaking, if we're like, okay, we're looking to analyze the support line of an uptrend, but we're also looking to analyze the resistance of a downtrend. If we look at our support and our resistance coming up and converging into the middle, it might be like, okay, hold on a sec. Which one should I even be looking at right now? Like, I've got a support line coming up and I've got a resistance line coming down. What is the potential outcome? Which one should I favor more? At the beginning, I would say neither, and wait for it to have its higher volatility moment out of the triangle before making a trade. Now, generally speaking, this is a little tip as well, but what we have noticed in this current market environment is it extraordinarily likely for the breakout of the tip of the triangle to come back to the tip of the triangle, to come back and try and retest its tip. Now, retest is a very common word that we'll use, and you will hear throughout the course of your trading, and that basically just means that a line that once was used and perhaps broken is now being touched again. And honestly, that happens a lot more than you would think. When a trend line breaks, yes, it does create a new trend, and that trend can be sideways or in the opposite direction, but it also often has a retest before it makes its new trend. So you'll notice that when we have the price coming down and it decides to break, before continuing up, it'll decide to retest and then continue. Now, that event of it coming down to touch the line again is the retest. I just want to clear that up. Let's take a look here. So, yeah, check the volatility. Now, this is another huge one. So, if we were to talk about indicators at all, it's kind of very important to talk about this one indicator, and it's called the VWAP, and it's called the volume weighted average price. Now we can go ahead on our on our trading view here and go to indicators and type in VWAP alerts V2. Or you'll see it pop up there. You might type in V2 and it'll disappear. So you just grab V2. Oh, they made a V3. Interesting. Look that way. But essentially, yeah, I've already got it on there. So essentially what that will do is that'll plot in the volume weighted average price. Now, many of you will have heard of this indicator as it is the mean. It is what we consider the middle. Now, it's really interesting because this one actually plots little clouds above and below, to essentially give you an idea of what is far from the middle. And that's really important when you're trading, because the way that we like to trade is, by definition, it's discretionary reversion to the mean trading. And that would mean what we're looking at doing is always trading back towards the mean. Now, this is a mean that starts at the beginning of every day's session. So you just have this as an intraday indication. So it's just an indicator that you would use while you're analyzing the movements during the day. And that's essentially what we would do, what we would use that for. So we would apply the VWAP, and we would notice that there's a certain distance that it may like to get away from that VWAP. And when we can determine what is high or low away from that VWAP, then we can start to look at, hey, let's say for instance the market strays what we consider relatively a far distance away from that VWAP. Now, what we would do is analyze that trend, and when that, like for instance, if it was going down, let's say, let's go replay here. This is what it looked like when it was down there. So it strayed farther away from the VWAP than it has been in quite some time. What it did was it allowed us to draw a resistance line that we were interested in, and it's in favor of it getting back towards its mean. And essentially, every time that it does get back towards the mean, back to the mean, it will 9 times out of 10 try to consolidate and try to essentially charge up, because the way that we look at it is it's almost like the price and the VWAP work as a tetherball. Like if we look at it like this, the tetherball pole is that VWAP, and the price likes to tether around that. Like imagine you've smacked it, and it goes spinning around that tetherball, and it always, at the end of the day, it always likes to revert back to it's like charging on that tetherball. So essentially, so we have the post here, and essentially the price likes to move around that post, and every single time that it gets back to that mean, it is essentially reverted back to its norm, back to its average, back to its the area in which that it feels it can go sideways, an area that isn't being pulled back towards any particular area because it is at its mean. And when it is at its mean, that is generally the most unfavorable place to trade it, because it doesn't have any elasticity of needing to get back to the mean by that point. So you don't have any it's not in favor of getting back to the mean when it's already at the mean. So that aspect of the trade is essentially eliminated, giving you one less thing in favor of your trade. Now, don't get me wrong, the price does move quite frequently off of the VWAP. Like you can see that it'll meet it, it'll consolidate, maybe stray away, only to come back to the mean, and then decide, it's having a great difficulty getting away from the mean right now. But you'll notice that it'll do that, and essentially some days you'll notice that the price will be a little bit flatter, and it'll be able to respect the mean a little more. Now, certain days you'll notice that it will not get back to the mean at all. Now that's an interesting concept, because it involves us looking at multiple different time frames. Because if we can see that the price is destined to get somewhere on a longer term time frame, like the 15-minute or the 5-minute, it may not be interested in getting back to its 1-minute mean. But generally speaking, it is always safer to trade back towards the mean than it is to trade at it or away from it. And that is one of the most core concepts that we're really going to be going over here on that one. But another cool thing I feel like I need to explain is the anchored VWAP, because you can actually take a VWAP and put it on any time frame put it in any place you want, and get the mean of that range. Like for instance, if you're just trading a small range and you want to know where that range's mean is, you can go ahead and put a fib right into the middle, and you'll notice, or not, sorry, you'll put a VWAP right into the middle, and you'll notice that it'll respect that as the middle extraordinarily. So every trade going back towards that mean, every trend break, in favor of getting it back towards that mean, is what we're looking for. And I'll show you exactly how that worked for us this week in action, and how to use that for yourself as well. But yeah, I do recommend everyone always understanding where the mean is so that we can trade back towards it. And let's see here. So, yeah, is this move relatively farther away from the mean than the last few times? Has it strayed away from the mean? What is the average distance that it gets from the mean? And the mean being that VWAP. So, and of course, like, there is a lot of information here, and I will be going over everything, like, with all of you individually if need be, to make sure that we all understand exactly what's going on here. And, so trend lines and patterns are super important, but without those other things in place, we really can't get down to trend lines, because why do we care about a trend line breaking? So that it can get back to the mean, so it can revert back to the mean. So when a trend line breaks, it creates a new trend, and if that new trend is supposed to be in the direction of it getting back towards the mean, then that's already okay, we're on the right track, and we're looking for that, and I'll show you how that works in a minute here. But support and resistance should be a priority. Keep in mind the top-down approach is generally the most effective, because you collect all the information. Like, think about it this way: if we start out on the daily, just remove all that, and we start out and we're like, okay, I'm going to draw in all my support, and that I can find on my daily chart here, and I'm going to, because it's going up. So because it's going up, I'm interested in the support, because when the support breaks, it creates a new trend, and because it is so far, it's so high and so far from the mean, it has that likelihood. And by the way, the market's at all-time high, and so it has that likelihood of being able to stray back towards the mean even harder than it ever has before. And that's what's interesting about this chart. So when we go to the daily, then we would say, okay, those are the major trends that we're really looking for on there. Maybe we'll put one more in there, like that. We'll just check the hourly and just see, is there any other trends that I could really draw in as support lines that might be impactful in the event that they're broken. That's basically what I would do next, and say, okay, what about this guy here? But that's an hourly chart. So what I'll do is I might change the color a little bit. Be like, okay, now I know that's an hourly trend line, and I know if I start to run up into these yellow lines, I'm starting to work on the daily, right? So then we go back into the 15, and we see, is there any other lines we can draw? Obviously, this one would have been a good one for that trend break, and it effectively broke it and created a sideways trend, which is unfavorable, but honestly, what do you expect during holiday hours? Honestly, but yeah, and then as we get in to the 1 minute, we can see that this is the most detailed that we're going to get, like where every single candle is 1 minute. And of course, we can go ahead and draw in our support and resistance lines on there. And we're like, okay, trend's going down right now. When that trend breaks, it creates a new one. But now I can see, hey, we start to run into these trends and start breaking these trends. I know, like I've color-coded them accordingly so that I can see when I'm running into them. I've got the short-term trend line and the long-term trend line. Now, as we went over before, like I do like to color-code my trend lines in favor of them breaking or causing trouble. Many of you will know the gold trends that I draw are intended to break. We want to see them break into new trends, and man, do we ever want to see them change into the other reverse trend. So the way that we trade is we capture the entry before the new trend even begins. So we capture the majority, if not all, the entirety of that new trend. And that's done by using different of it breaking the trend back towards the mean, it might just have like a little crappy pop and then fail right back in there because everything's not right about it. And we have the choice to wait to whether or not everything is going to set up. When I first started this group, we did overnight calls because everyone had to do options and nobody was doing anything but options, and nobody had $25,000 in their account. So I was like, okay, we're going to do overnight calls every single day. And for, I don't even know how long it was, I think it was 3 months, every single day we had overnight positive calls. Every single day. I can turn the channel back on so new people can see it too. Until we got to the point where I was like, all right, everyone, you can clearly see consistency. You can clearly see this is, building your accounts. You're building some money, and you can afford to get into new endeavors. Now, that's the point where I was like, okay, everyone's got to get onto futures. we got involved with futures, so we didn't have to do the overnight hold. But regardless, I don't want to go into that too much. Sorry, I'm kind of on track here. So, so basically trend lines and patterns. Most patterns involve a trend break in order to get their desired profit target. Like if we go back to this and it's like, oh, let's say that there is a pattern that's here, that's just supporting the fact that we're going to break that trend. And you know what's interesting is if there is a pattern, it can give you a very precise entry target. So you're like, okay, the exact point of this pattern where we're interested in going has an entry point of exactly here. And I can see that the profit target is favorably distanced away. So I can say, okay, at this profit target, like at this entry target that we're going for, like let's say, I haven't talked about any patterns yet, so I wouldn't expect anybody to know any, but let's say, for instance, there was a pattern. Patterns indicate, they tell us what to do. They indicate what price action is going to do. They tell us whether or not the price is going to break its trend or not. Because at the end of the day, each pattern just tells us whether or not that current trend is likely to break and how likely it is to break into a new trend that's likely to flourish into a profitable endeavor, essentially. So let's say, for instance, it allows us to say, hey, we're targeting for a specific level. And when we get into that specific level, and we would give it a predetermined risk-reward profile. And it'll look something like this. Like, for instance, here, you can even do this if you wanted to check it. I mean, you'll do it in your head eventually, but you can see, like, your stop with a 4-point stop and a 20-point profit target, the risk-reward ratio is 4.81 to 1. So, I mean, a trade like that is worth doing because, once you successfully complete the trade, you have the ability to take 4 more before you're even considering a loss. But that is something that anybody that, is trading has remotely some kind of understanding of risk-reward where you essentially want to make sure that your risk and your reward are in proportion. You don't want to have a bigger risk. Like it wouldn't make sense to take a trade that had a bad risk reward, that had a bigger stop loss for a smaller reward. It's better just to wait for the next one, right? And another thing as well that came to my mind that I really so with the risk reward, it involves this understanding that we can have protection on each one of our trades. So when we get into a trade, it's not just like, okay, I'm committing to being in, like, right here, and, like, if it goes down to here, like, oh, I've lost, like, $1,000, or, oh, God forbid, it fell to here and I lost $2,000, we eliminate that altogether by having what is called a stop loss. So every single time that we get into a trade, essentially, here, I'll show you on the sim here. Like, we can go ahead and buy in, and when we're into, this is a sim account, but what we can do is literally add a stop. So it was as easy as just right-clicking there. So now I know that no matter what, that will not be more of a loss than whatever I've specified there. So we can see the market, I don't even know if it's moving right now, but essentially we've committed to literally a small stop there, and you can decide, like, hey, like, if this is not an ideal point in which we would ever trade. But just to show you the stop, you know, we know that fluctuation down there, it cannot drop. Like if it had a million point candle and it went all the way down to the ground and went to zero, we would be stopped out right there with that small. I think it's set to like $5 loss right there or something. So barely any money at all. And if our profit target, you know, for instance, is up here, that's where we're trying to sell. Our risk reward is relatively okay, and we know that we've committed to a minimal risk with a reward. Now you can get into a trade where these are automatically set in there. So say for instance you get into a trade and it immediately goes against you, immediately like drops off the face of the earth. You're only going to lose this, whatever this is, $10, $20, depends on how much you buy. We have recommendations for how much you should buy. We're about to get into that as well. But essentially, that's why that's important. We're going to go on to the next one. Strength and momentum. So, like, this is how we determine whether or not a trend is going to break. Now, it's all good and dandy if we've identified a trend, but how do we know if it's going to break and actually revert to the mean? What are some things that we can identify that tell us whether or not that trend is worth even looking at? Is it worth trading back to the mean? Now, we actually get something that's literally, it's almost like cheating in a way, where it makes it incredibly clear, and what that's called is the moving average convergence divergence. We call it the MACD. You don't really need to know too much about how it's formed, but essentially all we would have to do is type in MACD. Personally, I have a customized MACD, but for the purposes of this chart, I'm gonna actually, I can show you guys my personalized MACD settings and so on. Basically, I like to use this one. It's called CM underscore ultimate RSI multi-time frame. And when we add that one on there, essentially what that, essentially what that does is it gives us this. This is an indicator that actually tells us whether or not, the trend is likely to break with strength, and whether or not it has the momentum to get to our price target. Now we're going to see this in action in a moment too. I just want to basically have everyone understand it so that we know exactly what the following pictures mean when I explain it. And yeah, if you guys have any questions at all, please interrupt me and do it, because I don't want to, because I can get off on talking about something all day. I could give me an hour on every single one of these topics. I can totally talk about it all day. But let's see. I'm trying to be quicker here. What I want to do is talk about strength and momentum. Does the price have enough strength to break the support and resistance areas? Is there a divergence, which we're going to talk about? Is there a reoccurring momentum pattern that keeps happening? Or is the momentum fading, like lower lows and lower highs? The slightest sight of that on any time frame can be a good indication of exhaustion. So yeah, this is an indication, the indicator that we use to tell us whether or not the price is exhausted, or whether or not it has the strength to break the trend. Now, typically what we'll see is when the price is coming down, we'll see that it'll make predominant lows, and we'll be able to measure those lows off of this indicator. Now, it might look a little strange, but realistically, all we're really looking for in this is the two lines that are in there. The two lines give us the most amount of information on that right now. So basically, what we look for is called a divergence. Now, for instance, we can see in this part of the chart up here where we have two clearly defined highs, we can see that within those two clearly defined highs, we do not have two clearly defined highs on the momentum. Now, that just simply tells us that there is an extraordinary amount of weakness and lack of momentum to continue. So what that would mean is we would immediately be interested in where's the support. Because if we're making new highs and our momentum's not, that means whatever support we're watching is in jeopardy of breaking. And if it's back towards towards the mean, then, which it was, you can see it even responded to with absolute precision. So those that were aware of the mean managed to get the precise exit. Obviously, it did break it after that, but it's quite interesting just to see how it responds to the mean in general. And in this case, so we have two clearly defined highs even here. So from this point to this point, we can see that the price has risen. Now, at that same point, if we look down at the chart here, we can see that we literally don't have that. We've got declining momentum while we've got an increasing price. Now that's called a bearish divergence. Now we can see that it's happening there, but it's also happening here. So we've got, let me just move something up. But this high versus this high, we've got an increase while we've got a decrease. So that means not even the short term, but the long term trend is in jeopardy. And essentially, I believe we took this trade last night, but maybe no, actually no. I was the trade that we did take. Yeah, we'll go over that. But essentially, I just wanted to basically show you guys how the momentum can be weakening and how it can increasingly affect the price. So we watch for that. Now, another thing that we like to see is when the lines are getting close together, that generally means that the trend is actually getting ready, or at least thinking about changing. It doesn't ever mean that it will, but it means that you should start looking at other parts of your system to see if it's in favor of making a good trade. Now, all of these things that we've already went over here, like the momentum, like, okay, first a trend breaks, now we're in favor of it. If the trend is breaking towards the mean, we like that even more. Now, if we have a bearish divergence, like in favor of breaking the trend back towards the mean, well, okay, now we're already talking here. We've already got a few things that might even make it worth taking a trade. So it's imperative that everybody understands that, though, before I continue. If you have any questions on what I just went over, everyone will learn from them, and I will answer them. So if you do have any questions, but I understand it's pretty straightforward. I hope I've explained it well there. But what we're going to do is go on to the next step now. So, let's look. So we understand momentum and how that can affect the trend, and whether or not that can affect the likelihood of the trend breaking when we get a bullish or bearish divergence. And a bullish divergence is just the opposite, right? So, let's take a look here. Like right here. Take a look at how we have a low with a lower low, where on this price action chart, it's actually trying to make a higher low. Now, sometimes it doesn't have to be an exact proportion. Like it doesn't have to be gaining as much as it's losing. On the price here, it doesn't have to be tanking down, like, and this has to be ripping up, like, but as long as we can see a divergence, like, it has literally made a higher point on the lines, and it's made a lower point on the chart, and by that point, and honestly, most of these moves you should be able to find in the chat, it put this trend in major jeopardy of breaking, right? So essentially, when that trend broke, it created a new trend based off of the fact that it had a need to get back to the mean, right? So the mean's all the way up here. It's in the green zone, for crying out loud. The triangles mean nothing. I should remove them. Don't ever consider buying on them or anything. They're not my entries or anything like that. So part of the indicator. But anyways, it just tells you how many standard deviations away from the mean that we are. But honestly, saying that just makes it more complicated for some. Anyways, essentially, this is a setup that was incredibly bullish. Like, we identified the trend. Price was going down. We identified the trend because we connected all the highs. We immediately knew, okay, we should be looking at this trend because it's far from the mean, farther than it has been from the mean every other time, which is wonderful. And then just to top it off, it had a bullish divergence, which broke the trend and allowed you to maintain your position from pretty much anywhere down here. If you got into an entry down here, there's no way you would have been stopped out. It didn't revert all the way back to the mean, but reasons why you would have taken profit, which we will get into another day. But essentially, yeah, this level here as well as this level here were two levels that that we would have been interested in, and I trade too frequently to be able to remember exactly the small moves, but that we did do. But I'm sure they're in the chat if you wanted to look at them. But regardless, I hope everybody understands that part right there. That's just really important. So I showed you the bearish one. I showed you a bullish one. We understand strength and momentum. You know, step 6. Okay, there's only 7 steps, so bear with me here. Reviewing your situation and determining the risk reward. So risk reward again is huge. Does the risk outweigh the reward? If looking at this ratio helps, then do that. You know, analyzing your current buying power and determining the amount that you should put into the trade is huge. So generally speaking, as you've been trading, you will have an idea of how much you are comfortable with trading. Now, one thing that we're going to talk about a little bit here is trade management, and exactly how we can make it easier for you to get into a trade that allows you to be able to hold it for the longest, that allows you to pay for its risk, and it leaves you with exposure so that you can let it run for infinity if you want. Now you can see how effective that is in current marketplace, seeing as the market has been grinding up forever, and at least the NASDAQ. And, you know, letting one run and that concept is something that's you know, well known for, you know, across the board. But essentially, what we like to do is we like to take 3 contracts, okay? So we like to take 3 contracts, but not at the same time. We like to take them 1, 1, and 1. So we start out by with our first entry. Now that first entry, you know, it's going to be mighty close to the other entries that you have, but the other 2 entries allow you to adjust your average price a little bit. So when you take your first entry, like if you're trading 1 contract, it's like, oh man, I've got to commit to this point, and if it doesn't move at this point and I don't like my entry, like it's you know, you're going to have a little bit of problems. But let's say if you buy 3 contracts, that gives you options now, because you have the ability to sell some and still be in. So what that can do here, and I'll actually do a visual for this one actually. Now that I think about it, I thought of a way I could do this. So step 6. Let's show you. So for instance, let's take this trade for instance. You know, by the point that it was, let's say for instance, you got in. You know, it wasn't even a good entry. Let's say here. Oops. Okay, we'll work with it. That's not a very good entry. So let's say you got in right there. And just let's double check how many points that is. 20 points. All right. So essentially, what that could do is if you had a clearly defined risk reward profile. In this case, like this move is a little large. So it was. It's a little bit more points than what we're used to right now. But let's say, for instance, we got that first entry. That first entry, the risk reward, you know, this actually would have been our profit target there. So the risk reward would have been 2 to 1 on that trade if you entered there. So it might not have been the best entry. So, and we knew that. So we're like, okay, we have a clearly defined target where we're like, okay, we know it's going to get there at some point, all right? And we're like, that's what when we see this trend break, we're going to try and get to that price target. And we know that before the trend breaks, because it's there. That's the price target, and we'll explain why for other reasons. Well, later. And I don't want to get into it too much because it is advanced why that price target is there. It involves understanding multiple patterns and so on. But for now, we'll understand that the price target's there, and we're trying to get 3 contracts. So, for instance, what we would do is you would have 3 separate entries that essentially would mean that we could try 3 times to get into this trade. Now, generally, it's a lot tighter than that, but for the sake of the explanation, we're gonna go with this. So we're gonna say, okay, we got into the first entry. The second entry that we had would have brought our average price down halfway, and that third entry would have brought our average price down another 25%. 25%. So our overall position would be on that red line there. So you know what's interesting is as it pops up, because we have 3 contracts, what we can do is sell one off. Now when you sell that top, always when you sell one, the first one that you get in goes. So this one would be the first one to go because you got into it first. So it would be the first one to go. And when that first one goes, that immediately lowers your average price down to these two. So what we would do is as soon as we saw it pop and it was profitable, we would sell that first one off to pay for the entire trade, and we would drag our stop into profit. So essentially what that would mean is if the market was to come against us and stop us out, we would have the money that we took off on that first contract. Because we sold that first contract as soon as it pops up and gives you some kind of green, you sell that first contract and you're working with the other 2. So you have 2 contracts left. And one of those other contracts is for the price target. One's for the price target. PT. If you see PT, that's price target. That's where we want it to go always. And essentially, we save one for that price target. Now that other one, it literally is saved for infinity. Like it's saved until you literally think it's a short, or until you think it's gonna seriously move in the other direction. But what this does is it gives us exposure. So like for instance, if you had have taken this strategy and done 3 contracts, you take one off, it pays for the trade. So no matter what happens, even if it just went like this, by the time you take one off, as long as you just got one out, you've paid for your trade, and essentially, no matter what happens with these next, they're just basically running to see if you can get your price target. And if you can't, then you've been paid for your trade because you sold one. So what that means as well is, okay, when it gets to the price target, you sell one, because sometimes it might not stop above your entry. Sometimes it might come all the way back down and continue bearish. But the thing is we take one off of the price target because of the reason that, yes, it very well can reverse the price target like we can see there. And that means we've locked in the majority of our profit. We've executed the trade. That last contract is essentially free. And you know what you can do with it? You can leave a stop loss at a break even, or even at a profit if you want to. Many people drag the profit up because they want that extra money, and that's fine. But you know what's crazy is those that are usually patient and leave it at a break even would get all that too. So quite interesting. So leaving that last one to run can mean getting a hell of a lot more of a move than usual. So it leaves you with exposure, and you've paid for the trade, and those are some things that we can use to manage our trade a little bit more effectively. Now, I wouldn't expect everyone to honestly get that one down right then and there, and honestly, like I can explain it in 10 different ways. So, and it's weird because every single day I'll come in and I'll explain something, and it's like I'll explain it multiple different ways, and one day it's just like I'll come in and explain it a different way, and it'll click with however it needs to hear it that way, and I find it relatively extraordinary. But if you do have any questions, definitely interrupt me. But that is one thing that I would consider part of our rules, and I do think that it's incredibly easier to trade when you give yourself the option of using 3. Now we don't just sit at 3 always. When you're ready to increase your size, then instead of going 1, 1, and 1 like here, then you would go 2, 2, and 2, or 3, 3, and 3. But always giving yourself the opportunity to adjust your average price slightly, so you're not committing to what doesn't have to be the best entry. And what's crazy is as you sell one off, your first entry, it goes, and it lowers your average price to your other 2 contracts. And then as you sell your second one off, that's the second one that you bought right there, right? And then now it's gone. Look at where your entry is. Your last contract. It's all the way at the bottom. And it is the least likelihood of getting stopped out. Because that's now your average, and it's at the very, very bottom. So now you can let that one rip all the way, and it has the least likelihood of it trying to retrace and come back and hit you out, because it's the lowest one that you have there. You've reduced, as you've been taking profit, you've been increasing the likelihood of being able to stay position at the same time. So, and you'd be surprised, like with just one small contract, how much potential that can do when running extraordinarily amounts. And like let's say for instance this trade continues on, and next couple days, you've got like 100, 200 point cushion under your belt. And all you have to do is monitor whether or not you think its current trend is going to break, and whether or not you should do something about it. And like there's I'm more than willing to like help you in trying to think of what scenario would be best for your current trading situation, and exactly how to manage out of whatever issue or anything for that matter that you're trading with. And yeah, that's cool. So we're gonna go on to the next one here. Is it a high or low probability pattern? We're going to get into patterns eventually, but I don't think we're going to go into them today as much. What is the probability of it getting to the price target? So, like, do all of these other things line up? Like in a nutshell, like we've identified that the price is far away from the mean. So what we're going to do is we're going to slap a trend line on it, because we care that when that trend line breaks, it's going to revert to the mean. Now, when we have that trend line on there and we're thinking, hey, when's it going to break to the mean? We check the momentum to see the strength of the trend, to see what is the likelihood of it being able to continue riding this trend on weaker momentum. And as that momentum gets to a point where it's like, wait a second, we've made a clearly higher high here where the momentum's saying down, that means the trend is likely going to break, because these indicators indicate what the price is going to do, based off of what it has done, ironically. And that's that in a nutshell. So as we get to step 7, which is here, consult your day trading chart. So you're going to watch the fluctuation of your, let's take a look here. Yeah, so that hasn't moved yet. You're going to check your trading chart. So that's going to be the final step, looking at exactly, like let's say, 30-second chart. Obviously, right now that's incredibly difficult to read. I also doesn't help that I have I don't know.
What's happening with those blobs of candles?
Yeah. That's not supposed to be like that. It's supposed to look like those are equivolume candles. They basically mean that the fatter the candle, the more volume there is. It's kind of a cool concept. Just means that people, like, you could see, like, nobody cared about it in there. It was like barely could make a candle. But essentially, okay, that's the 30-minute. We want to go to 30-second usually for entries. Generally speaking, that'll give us the most clarity. I just popped this on for default, but essentially you'd work your trading platform in a sense that would let you see. It would help if it was moving right now. I think you can actually look at Bitcoin on here. I'm just gonna see just to get some movement on here. See if it. Oh, it's horrible. Never mind. Sorry. Essentially, we'll look at it tomorrow again though. But when the market is moving. But essentially, you would consult your day trading chart just to make sure, like, are the candles fluctuating in a favorable manner? Is it still, moving towards your price target or entry target, or is it like, are you getting ready to take the trade? Like, you would look at all of the different order entry things that you would need to do in order to make sure that you're going to effectively take the trade. Like, do you have your stop put in before you get into the trade? Like, is there an open order? Like from your last trade, like, did you forget to close an order and it was like, and it's sitting there, and if the price suddenly gets to whatever that price is it going to make you get into a trade? Like, all those kind of things. You want to make sure that you've checked everything in regards to that. And if in the event that this pattern doesn't play out in favor of what you are, speculating, what is the plan for that as well is very important. And execution, anything that you do in regards to execution, whether or not it's managing your stop, adjusting your quantity, anything like that would be done on the 7th step. And just double checking your risk reward profile. It's like, wait a second, is this a 10-point range and I'm looking at a pattern everything lining up? Do all of those things correlate with each other? And it's like, no matter what you're playing, what pattern you're trading, what stock you're trading, what contract you're trading, I don't care what it is, all of these things, in my opinion, must be considered. You'll have to use discretion to determine how many predictable factors this trade has on its side. The more positive predictable factors you can see and the lack of negative ones, you can then determine the risk of the trade. So high probability versus low probability trading, mid-range trades carry increased risk, and are mostly low probability. Like when trades hit the view app, like I say, like you'll see, it's crazy is you'll type in view app to YouTube and you'll see like people will go like, oh, it's crossing through the view app and it's bouncing off of it now, and it's like that's when you buy. It's like I cannot believe that there is information out there that's literally so wrong. Overextended setups would result in higher probability opportunities. You can tell a quick scalp from a large move when analyzing the current trend and look out for the length of the trend and the time frame. Apply Fibonacci levels, which we have many videos on, and we will go into that. But I am going to save that for another class where we're going to go into like more in-depth indicators and drawing tools and exactly how to trade patterns, because today we didn't really go over how to trade patterns, but essentially what I've given you so far is the ability to take whatever patterns that you do know and be very careful with that and understand when applying the system to those patterns, it will greatly increase the effectiveness of playing those patterns. Now, of course, I've got many videos on all the different patterns and so on like that. And I will do another class next weekend, too, about the patterns. But common obstacles. When your trade is going against you and you're going to get stopped out, should you add or move your stop and look for a new entry? My opinion, you'll always want to commit to whatever plan that you had before you get into the trade. So there's no like, because it's going against me and I originally committed to a 20-point loss. If this was, I'm going for a 200-point gain, but I'm saying 20-point loss is what I'm comfortable with, and it gets down to 15. Don't be dragging it to 30 and 40 and just watching it go down. That's horrible. We don't do that here. So we don't move our stops. We don't commit to more of a loss than we've already committed with at the beginning. Because if you were wrong, you're wrong. It's not the next level or anything like that. It's a whole new trade that you need. It's not fixing this trade or anything like that. The market doesn't care about how much you're down, and it's like we want to make sure that we're focused on exactly what the market wants us to be focused on, not whether or not we feel that because our account reflects better, that it's supposed to go up here, or when I hear, okay, I've got $1,000 profit target and I'm at 995, come on, it's like, man, sell that shit, in my opinion. But there's no like trying to fight for that extra dollar to make it feasible in your head, like because it's like, oh, I like the round number or anything. Market doesn't care. Market doesn't care. So we trade with the most logic in mind, and feeling as though you missed a trade and letting the emotions get the best of you. That's another common thing. Like I'm telling you guys right now, this is going to be difficult. Learning how to trade is extraordinarily, it takes a lot of perseverance. It takes a lot of effort. And is it worth doing? Hell yeah. Like you can ask half the people that you see are successful in the chat and execute these strategies on a daily basis. And is it difficult for them now? No. It's not difficult to do once you know how to do it. But I think that's very similar to many other things out there. But the learning curve is different. Diamonds are built under pressure, and skyscrapers weren't built in a day, right, guys? So I'm not telling you that you're going to learn how to do this easily. One thing that will make it easier is if you do follow the steps. Now, one thing that all of the people that are successful in this group have in common is that they've actually followed the steps, and that they've understood exactly how to consistently repeat what they do on a daily basis in order to get the same results. And it's like I'll get phone calls being like, hey, is it always going to be like this? Like it's unbelievable to me that I'm actually being able to analyze the market and execute trades on a daily basis without losing. And it's like, you go to the bank, they will laugh in your face if you tell them that. And it's like, it's ridiculous. And we can see that just through following the rules, that's exactly what we want to focus on. So you don't have to put everything onto one chart. Many different trading setups you'll see. and monitors. And you know what that does? That invites clarity. It means that we can look around and see exactly how, what indicator is doing, and watch it on its own, and actually be able to see its its full potential without any clutter of something else. Having your chart set up clearly is key. Another thing as well is, like, I'll show you, like, you want to make sure that your resolution is relatively good. Like you can see the wicks and the candles and everything like that. If I scroll out like this and start to look at this chart, oh sorry, automatically I went back in because it just didn't sit well with me. But essentially, we can't read the chart as clearly on this time frame like that, right? So we would want to have it zoomed in to the point where we could see like that. Now, it doesn't mean we can't look at it like this, but it just means that we want to look at it on a little bit of a clearer time frame. So the 15-minute, now that whole range, instead of it being all crumpled up like that, you can actually see and dissect each candle movement. Because we will get into it, but each one of these candles can form its own pattern. So there's small patterns that happen as a result, like 3 candles down, then 1 up can mean down again, or things like that. And when you see something like that happening right before one of your trend breaks that's in favor of going back to the VWAP or the mean, and it's got that momentum on its side in favor of it breaking the trend and getting back down there, and it's far from it, it's like Bob's your uncle at that point. You may as well really be looking for that entry. And exactly. And so basically, with everything that we've learned today, I'm just going to quickly show you guys exactly how that works in action. So we're going to take about 5 different slides or so. It all depends. Let's see here. In order to maintain efficiency, a system will help ensure you do not waste time and eliminate confusion. Using this system is ideal alongside any other refined trading strategy or setup, as it confirms that you do not miss out any of the technical aspects of the trade. What we do at the end of the day, like we check any positions that are open. We want to make sure that there's no mistakes that can happen, because we are human after all. You want to make sure that you avoid as many mistakes as possible and you're focused as possible on and check your open orders at the end of the day. Review the consistency of your trading and make sure that if you did make any mistakes, you should really write them down and post them in front of your monitor so you don't make them again. And like whatever you need, everyone learns differently. And I respect that everyone learns differently, and I'm trying my best to make sure that I tailor my explanations around, the ways that people will learn the most effectively. And no matter what that is, whether or not that's having a conversation where you have to ask questions and see it, like I will show you every day, all day, every day, how to do it on a chart that you can all look at, and essentially throughout that time you can ask any questions you want, and we are literally doing it alongside you and watching for these trades as we go. So yeah, learning really begins up right after you have the conceptual understanding of why and how the price moves. Our videos and live training sessions, combined with the vast expertise of our community, provide the tools required to achieve consistency. Having a mentor to bounce questions off of can greatly improve your learning curve. The one thing that's very apparent is those that ask more questions end up doing better. Worthy goals. Being able to find an excess of trades on your own platform, consistency is huge. Develop a good trading habit, which results in confidence throughout regular consistency. And you want to get set up with a realistic plan, and everyone's plan is going to be a little bit different, and I understand that. And nobody is at a loss when it comes to that. I have time to talk to every single one of you guys, and if you are uncomfortable with your plan, that is the first step, is understanding what you're supposed to do so that you don't worry because you know exactly what's going to happen and all the different outcomes. And that if you're worried, it's because you don't have a plan. And that's like it goes with anything, really, not even just trading, with life. But install a trading platform. We recommend NinjaTrader. TradingView is what we use to chart on, do our analysis with. NinjaTrader is by far one of the most responsive brokers to trade futures in the world, and many have had great success using it. So one thing we're going to go over. Okay, so this is the fun part. So what we're going was super slow in regards to both directions and trend breaks and so on. But essentially, when we look at this chart, the first thing that we look at is, it had reverted back to the mean after having broken this green trend line. So essentially, we just woke up in the morning. It was like 7 o'clock in the morning at that time. I did put the green trend line on there, but at that time, I changed it from being gold into being green. And I didn't post a picture of it because this was the first picture that I posted that day. And you can see, like, this is the picture. We're just getting everything sorted. We're looking at starting the day at yesterday's mean, approaching the VWAP and the 50%. So I'm trying to get everyone aware that we're, right at the middle, that it is a little bit riskier to trade at the middle. However, we are looking at the fact that it's literally going up. So it's going up right now. We connected the support line to that trend. We're interested in watching that trend break. So as that trend broke, immediately a new trend is formed. A new trend, which we analyzed with that little purple line. Realistically, I didn't want it to be incredibly popping because of the amount of risk that there was associated with this trade. But regardless, it did break the trend, and we did end up making it yellow. But now we have an interesting setup, because what has happened is it's fallen into a symmetrical triangle, which is a consolidation pattern, and it is a pattern of indecision. Now, if you go out there on the internet, you'll find so much information on the, symmetrical triangle, breakout this, breakout that, continuation this, continuation that. We don't trade symmetrical triangles because of the fact that they are fake out triangles. They are most likely not going to continue. They most likely fake out before they do anything. A lot of the times we stay away from them and trade back towards the consolidation or back towards the triangle, because there's significantly better risk less risk involved with that. And I could do a whole class on trading symmetrical triangles, but we're not gonna get into that precisely. So we waited for the symmetrical triangle to go, and what happened is that created a new trend, and that new trend we identified with a yellow line. Now you'll notice that when we're charting throughout the day, and I make a symmetrical triangle, I will make those lines purple, and essentially blue lines are going to be used for just levels that will cause trouble. Essentially, blue lines are generally responded to from both sides. I like to draw them in because they will often break and they will often get responded from both sides, but we're not looking for them particularly to break. They're more like, if we stray away from the price and then end up running into a blue line, it's probably going to hold it. It's probably going to reverse at it or consolidate on it at the very most. So we're weary of the blue trend lines that I put up there. But essentially, as we can see from this chart to this, there were many other reasons. Like many of you will be familiar with this 188, which we're not going to go into today because I don't want to take up too much time. Oh, geez. And we're almost done here. So I'm just going to explain this. And essentially, momentum is picking up. We can see on this chart here, we had, oh my god, that's exactly the one that we were looking at before. Jeez. So yeah, this is exactly the one that we were looking at before, and we had the two price targets there, and I was like, okay, this is the price target, we'll explain it later. We see an inverse head and shoulders getting us to the B point. That might be the case. Yeah, okay. So eventually, it tried to make a right shoulder and then continue up to its B point, and then as we can see, it's continuing up there, and this is for some perspective, where was that? Here. 50 points. So, yeah. That's roughly like a $500 move right there. And it took on one contract for an NQ contract right there. So, yeah, not too bad. Anyways, and now, one thing that we see is as it's hitting our price targets, it got to our price target. Now we're like, here's the B point, which is the price target. B point, price target, the B point is part of a pattern in which gave us reason to believe that was the price target in the first place. So that's what we called the B point. We wanted it to hit that point, and of that pattern would be the B point. But that's another thing. I've got a whole class on those patterns as well. But it reached the form of in the form of a 5-wave move. Now we know 5-wave moves generally reverse, and that's another pattern we will go into next week. But regardless, all I want you to look at right now is the fact that we simply spawned in a yellow line there as it hit where we thought it was going to go before. Now we were watching weaker momentum. This suggests the yellow trend might break soon. So the yellow trend broke and immediately came right back down to our support. So far, capturing the entirety of all of those moves with precision. So here's the V point, the bearish harmonic pattern that played out as a result of the trend break from the 5-wave move. And then we quickly looked at, momentum, and this is the 2-hour chart. And essentially this next chart, it came down, we were like, okay, yellow trend line. We're like, bam. Created more of a yellow trend line there. We're like, okay, capture this entire move up. When a yellow trend line breaks, I like to make it orange. Kind of like just like dulls it out. I don't want people looking at it thinking, oh my god, yellow trend line, we're doing something with it, because we're not. And we go look at these new trend lines here now too. And I was like, okay, nice run on the NASDAQ, broke some serious levels, approaching the VWAP now. Because that's that guy right there, right? So we're like, okay, we traded back towards the VWAP. We wanted to get back towards the VWAP, and that, like, that's what, how many points is that? That's another 50 points right there. So it's like, that's like, we're talking thousands of dollars worth of trading in one day here on one contract if you wanted to. Now, if you followed the rules and did 3, that first trade would have been $1,500. This one would be $1,500. You're making good money. And essentially, this trend line broke, just like we would expect it to. Now, all of a sudden, we spawn in another yellow trend line, and all of these, as you can see, are literally in the chat. I post them right there. So it's like, and I'm streaming this chart live while you guys are asking me questions about it every day. So it's like, I'm like, everyone should be making tons of money on that. Anyways, what you are. And we're watching a short-term trend now off of the dump. We just had, consider taking some off if you're still short, right? But this is a long scalp area. So we're looking at going long for a short period of time. And then bam. And then what did I say when it got here? Yep, this is the PT. Some off, put your stop in profit, protect the trade. We're at the VWAP too. One and more off here if possible, yep. It has risen into an H. That simply just means like it looks like an H, but it's upside down. Something we generally like to stay away from. A lot of people call it a double top, which is, I can talk about the double top as well, but I don't want to take up much more time. So, yeah, basically we called that out. Now here we go with another yellow line, part of a pattern. We're like, okay, immediately it breaks. There's more profit potential right there. You just put your stop in profit, see if it runs. Ended up running, broke a couple more trends on the way, and basically, like, that was the range that we were trading there, and like the entirety of it, and yeah, that's basically everything that we just went over right there in action. Usage of the VWAP, usage of the trend breaks, watching the momentum break the trend, and it's like this every day. Test me. So yeah, pretty much that's what I wanted to go over. Sorry it took so long. I didn't realize it would take that long. I could talk forever. But if anybody does have any questions, I'd be more than happy to explain them. I hope it was clear, and I will do this class again at some point. But I'm going to do a part 2, which will regard the patterns and using indicators to effectively trade all of the patterns. Like, you guys already have a great idea of exactly, okay, we're going to come in on Monday, we're watching for that, Tuesday, we're going to come in and watch for that, those trend breaks. We're going to watch the momentum and how far it is away from the mean. And, tomorrow, like, you're going to see, like, I'll take time out of the day, guarantee we'll explain any pattern that's on there, and I'll teach them as we go. So, with in mind that people are going to be new, and we're going to be there doing that. So I'm excited. I think it's going to be great. We had an extraordinary year last year. Over 8 millionaires were created in this group. Over 20 million. No, 15 between them. So we can get you guys there. I'm confident. Not a single one of them has anything in common other than the fact that they followed the rules. So that it didn't. I just want to make sure everyone understands that they'll be able to follow along with it in the coming week. And I really appreciate you guys being here and learning this as well. And I'm excited to see what we can do with it and exactly what where this brings you guys and what we can accomplish as a group together. Now, on a side note, as we do progress throughout the remainder of the year, the goal isn't just to simply just teach and have everyone trading here and everything like that. The idea is to condition you guys to be able to work in a hedge fund, so that by the end of this, your trading and results will reflect on what opportunities you can get in the fund to come. But that's long term. Anyways, much time to learn and become an analyst and get it up and running within that time. So I'm looking forward to getting to know everyone and to work with you guys on a more personal basis as we come into the new weeks to come. And I do think that this year is going to be an extraordinary year, a very exceptional. And in terms of volatility, I think we're going to get more news events, more craziness, and that means more opportunities for us at the end of the day. As long as she moves, we've got it. So that's all that we need. No sideways action, please. But yeah, no. Do you have any questions? No. Yeah.
I did have one. Earlier on, you talked about trading off. You're on TradingView. You're looking at one of the tools that measured like the angle and like
Totally.
You said that it was like a good way to. You said that not a lot of people used it and stuff because it was just kind of a.
Nobody notices it, I think.
Right.
Yeah.
What is what are some of the what is like a good use for that?
Oh yeah. So it's not going to necessarily tell you to make a trade, but it'll essentially it'll be like, okay, like how many points do we have from here to here? I can see that that's 35 points, and if I move that around, I can use that as a 35-point block as well if I wanted to, because sometimes like what you'll be trading and it'll be like, okay, you'll sit down and like you'll say, okay, well how big of a move was this actually, and it's only 25 points, and it's like because I did that real quick, I can actually see, and you don't actually have to do the math in your head, and anything to avoid using the brain power really is going to give you the energy that you need for the rest of the day, because sometimes you have to be aware of how much energy you put into analyzing and trading, because sometimes when it's consolidating and you think about it really hard, you get worn out for when it actually starts moving again. And we're all different and we're all human, but another thing that's very important about using this is the angle. So we particularly, and this is actually really important that you ask that, because an angle is incredibly important of whether or not the trend is going to break. So if we have a crappy angle, the trend might not break into a favorable, like this one, for instance. We can see here, like roughly from here to here, we've got like a 29-degree angle essentially, and that angle broke, but it was like, and then we get a steep angle, like one of these guys down here, like a 60+ degree angle, and it's like, yeah, we're in business for the reversal. So the angle of the break can be really important.
Personally, the angle, it's like sort of useful, but it's also, it moves when you zoom in and out, so it's not like the same. So it's not like the most reliable, I guess. Like if you zoom in and out,
it's
change there.
Yeah, like
right.
you would never you would never be like, oh, it's a 41-degree angle, that means I'm going to do something. It's just like, as long you're going to do better with just visually seeing, like, hey, is this steeper than it was before? And what's interesting is it does move when you change it, but like as you measure that, like if I'm like, okay, measure that right there, that's 49-degree angle, I can move it around, it might change it and stuff, but when I first initially measure it and I gather that information, it's correct. So like whether or not you like I won't like move it around then go back and be like, wait a second, what was that again? And then it's different and then I'm screwed or something. No, it wouldn't work like that usually. we would just say, okay, we'll check it once. We'll say, hey, we've got a steep angle here, like, and realistically, like, even that process of checking the angle can take time that you would otherwise need, depending on what time frame you're trading on. Like, if you're trading on a very short term time frame with a pattern that's about to break out, you might be thinking, damn, why did I check that angle? Well, instead of taking the trade, right? Like, I could clearly see it was steeper than the rest of them, you know what I mean? and
It's kind of like it's kind of like just another indicator of something that may or may not happen. But it's also something that gives you. It's kind of like efficient in terms of workflow. 'Cause you said it's about like being efficient with your time and finding a good workflow so that you're able to make and execute trades or execute decisions based on the information.
Yeah, totally, man. And no, that's it. That's pretty much all I would use those ones for. And you know, there's so many different bells and whistles that you can do. Okay, first thing I have to mention this. This is super cool. When you make a trend line on TradingView, you can right click it and add a freaking alert to it. So anytime that you know you're riding on an uptrend, and then it crosses through and it alerts you on a diagonal angle. So you can put an alert on an angle, and it's like when the trend breaks, you get a push notification to your phone. That's super cool.
So it's not just like a price. It's not like a price target. It's also an angle. Target, I guess.
Well, it's like, let's say for instance, you know, the price is going down right now, and like, you know, you're barbecuing or something on, and it's like you want to know when that trend breaks, right? So we would be like, okay, add an alert here, and like, let's say it floats around, it goes down a bit. As soon as the price crosses that, you'll get an alert. So you can put an alert like on an angle, because usually when you make an alert, it's like I have an alert, put it here, and it's on that price level. Now it's great if the price comes to that level, you'll get the alert, but it's only that horizontal level. Now it's like I'll get alerted if the price crosses it here, if it crosses it here, if it crosses